What if the difference between panic selling and building real wealth comes down to having just one system? Because most investors don't lose money because of bad stocks. They lose it because they don't know what to do when things go wrong.
Have you ever had that feeling, that gut-wrenching panic when a stock you really believe in just starts to nosedive? And every headline, every alert on your phone is just screaming sell while your portfolio is bleeding red. Yeah, me too. Today, we're going to build a system to replace that chaos with cold, hard conviction. We're going to give you a data-driven framework for your investment decisions. So let's dive in. This quote, this just hits home, doesn't it? It comes from a real story in our source material. Someone invested in a market-leading company, and then bam, it tanked, and fast. In that moment of pure panic, what separates a huge loss from a long-term win? Well, it isn't some hot tip from a guru. It's having a system, and the confidence that comes from doing your own homework. And that's the real question, isn't it? It's not about trying to avoid market downturns. They're going to happen. It's about building a framework that lets you act rationally when everyone else is, just reacting emotionally. And that is exactly what we are going to build right here, right now. So here's our game plan. First, we'll talk about why having a system is so important. Then, we'll figure out what a quality company even looks like before we build our own data-driven screener to find them. After that, we'll connect the numbers to what's happening in the real world, and finally, we'll pull it all together into a smart, balanced portfolio. All right, let's kick things off with our first section. The whole goal here is to shift our mindset completely. We're moving away from making decisions based on fear or FOMO, and instead, moving toward a repeatable, logical process. Now, let's be super clear about something. This explainer isn't about giving you a shopping list of stocks to buy. Not at all. It's about giving you the tools, the framework, to find great companies for yourself. We're building a system designed to filter out all the noise so you can focus on what actually matters, the numbers and the story behind them. Okay, before we even dream of looking at a single financial metric, we need a simple qualitative filter. I mean, what does a fundamentally strong business even look like? This section lays that groundwork with 3 really simple rules.
These 3 pillars, they're our starting point. First, does the company basically own its market? A monopoly, where something close to it gives them pricing power and a serious competitive moat. Second, is it consistently making more money? We want to see a real track record of success, not just one fluke year. And finally, low debt. A company that isn't drowning in heavy interest payments is way more resilient. It can pretty much survive any economic storm.
All right, now for the heart of the whole system. We're moving from these big ideas into hard numbers. This is where we build a quantitative filter, a screener, to systematically hunt for companies that meet our super strict criteria for both growth and value. Our very first filter is the PEG ratio. Now, a lot of investors get hung up on the PE ratio, but the PEG ratio gives us so much more context because it actually factors in growth. We're looking for a value under 1.2. Why? Because it helps us answer the most important question. Is this company's growth potential worth the price I'm about to pay? A low PEG suggests we might be getting that awesome growth at a pretty reasonable price. Next up, we demand proof of performance. We're filtering for companies that have grown both their sales and their profits by more than 10% a year for the last 5 years. This is so important. It helps us weed out the one-hit wonders and instead focus on businesses with rock-solid fundamentals and great management that can deliver results year after year after year. Now we look at efficiency with something called return on capital employed, or ROCE. We want this to be over 15%. Think of it this way. For every single dollar the company invests into its operations, its factories, its tech, whatever, how many cents of profit does it spit out? A high ROCE tells us that management is just incredibly good at using its money to make more money. That's the sign of a truly great business. Financial companies like banks, they're a different kind of beast, so our filters need a little tweak. For them, we use the price-to-book ratio to check the valuation, and return on assets to measure how profitable they are. An ROA above 2% is a really strong sign that a bank or financial firm is managing its assets well to generate earnings. And here it is, all in one place. This table is our data-driven filter in a nutshell. We're looking for decent-sized companies with a PEG under 1.2, consistent double-digit growth, and just incredible efficiency, shown by both ROCE and return on equity being above 15%. This right here, This is the machine that finds potential gems in a mountain of rocks. So our screener spits out a list of companies that look great on paper. Awesome. But numbers alone aren't enough. The next crucial step is to understand the story. Why is this company doing so well? What's the powerful, real-world trend that's pushing it forward? Let's walk through an example to make this real. One of the biggest megatrends of our lifetime is the explosion of data, right? AI, cloud computing, all the shows you stream, it all runs on these massive data centers. And this trend is creating unbelievable demand for some very specific things. And this just illustrates the connection perfectly. What do data centers need tons and tons of? Copper. We're talking miles and miles of copper wiring. But here's the catch. You can't just flip a switch and make more copper. Opening a new mine is slow, it's incredibly expensive, and it's hard. This sets up a classic supply and demand problem, which could drive the value of copper through the roof. And this is where the system comes full circle. When you run the numbers through our screener, a company like Hindustan Copper pops up. It meets all our tough quantitative criteria, and it's perfectly positioned to benefit from this huge long-term data center trend. See? The data led us straight to a compelling story. Okay, finding great individual companies is one thing, but building the portfolio that can actually withstand the test of time is a whole other ballgame. Let's get into our final section and see how all this builds into a structured strategy for managing your investments for balanced long-term growth. The strategy is beautifully simple, and you can see it right here. It's a 3-bucket model. We put 55% of our portfolio into a stable foundation, 35% into the growth companies we found with our screener, and that last 10% goes into what we call high-conviction bets. The biggest part of our portfolio is the foundation. This bucket is all about defense, all about stability. It's filled with core, reliable assets that are designed to hold their value, or maybe even grow a little when the rest of the market is going crazy. This is the bedrock. This is what helps you sleep at night during a crash. Our second bucket is the engine for growth. This is where we put those awesome companies that our data-driven screener found for us, the ones with proven track records and strong fundamentals. This 35%, this is what's going to drive the long-term appreciation of your portfolio. And finally, our smallest bucket. This is for our high-conviction ideas. This 10% is for those opportunities that you've researched deeply and you believe in with every fiber of your being, even if they're a bit riskier. This is where you can take those calculated shots on potentially massive future winners. So to bring it all home, here's your framework in 3 simple steps. First, start with those core principles of quality. Look for monopolies, profit growth, and low debt. Second, apply the data-driven screener to find the companies that actually meet the numbers. And third, assemble those companies into a smart, balanced 3-bucket portfolio. And there you have it. We've gone from the chaos of emotion to the confidence that comes from a system. You now have a repeatable process to find great companies, to understand their story, and to build them into a portfolio that's built to last. The only question left is, what hidden opportunities are you going to uncover?
Because in the end, the investors who win aren't the ones who predict the market. They're the ones who control their reactions to it. If you want more frameworks like this that turn confusion into clarity, hit subscribe now. Because one system can change your entire financial future.